Hey everyone, me Kevin here. In this video, let's break down what 3 Federal Reserve Bank presidents just said over the last day. We're going to hear from Cleveland, Atlanta, and Boston, and one of these 3 is a voting member on the FOMC, one is an alternate voting member, and one is not a voting member, but all of them have vocal opinions when it comes to what the heck the Fed is going to do. Just so you know, this is very, very important in terms of what the Fed is thinking of doing, because currently there are expectations that, the Fed's just not going to raise rates until after 2023. Everything's fine. We're not going to see interest rates go up for a while. And if rates don't go up, then the stock market will just keep going forever. Moon, here we come. But if the Federal Reserve changes course, kind of like what Cathie Wood suggested that might happen, maybe she's been picking up on some of these interviews as well. Wouldn't surprise me. Barron's ran an article on this as well, and so maybe Cathie's reading Barron's. But anyway, Cathie did suggest that, hey, she thinks it's entirely possible the Fed's going to change course and maybe raise rates sooner and stop the money cranking printer a little earlier than we all expected, and nobody wants the party to end before we all expect it to end. Well, therefore, we're going to break down what 3 Fed bank presidents just said. Very important. First, we are going to start with Federal Reserve President from Atlanta. This is Raphael Bostic, and here's what he has to say. He thinks that interest rates could rise sooner than forecast. And while he does not currently have a vote on being able to raise rates or not, he does serve as an alternate member, and he's a vocal member. So here's our alternate member. Either way, Raphael Bostic is now suggesting that interest rates could rise sooner than forecast because the economy is recovering more quickly than expected. Most of the voting members in the Federal Reserve so far disagree with him. In fact, what I'm going to do is I'm going to show you the Federal Reserve's dot plot on what their expectations are for interest rates. There are 17 folks who have submitted dots, and what they do is they submit a dot for every year. So they submit a dot for 2020. What should interest rates be? Okay, 0. Got it. What about 2021? What should they be? Okay, 0. Got you loud and clear. Oh, here's one dot that thinks we should be a little bit higher at about 0.5, 0.25 to 0.5%. It's not until you get to 2023 that you actually get 5 people here that think interest rates should have been bumped. And it's actually not until after 2023, that is the longer run, aka after 2024, that you get every single dot plotting member to say rates should be between 2 and 3% at the Fed. So this is your dot plot here. Most of them are suggesting we are not going to see rates increase until after 2023. In fact, if we go over here, we get the median expectation for inflation and interest rates and some other factors. This is really important to pay attention to because this is how they set policy. So this is where we could see the median expectation is, again, interest rates being basically 0 all the way through 2023, and then in the longer run, rates should be 2.5%. That's what we see right here. When it comes to inflation, the Federal Reserve likes to use personal consumption expenditures as a measure of inflation instead of the consumer price index. They think it's a little bit more accurate. They tend to be pretty similar, though. But you can see we struggle to get to 2% until by 2023 based on these projections. And in the long run, they think we'll sit at 2%. So we don't have this median expectation of rates going up here for a while. But Mr. Bostic disagrees. Maybe he's that one dot. They don't tell us who that one dot is, but maybe he's that one dot who plotted a dot that maybe rates might start going up in 2022, which is really now only, it's weird to say, it's 11 and a half months away. That's weird. I feel like I'm still stuck in 2020. But anyway, he says, quote, I do think there is some possibility that the economy could come back a bit stronger than we are expecting. If this happens, I am prepared to support pulling back and recalibrating a bit of our accommodation and then considering the policy rate. That's a huge statement right there. He's going, hey, look, if the economy does end up stronger over the next 12 months, dude, I'm ready to say we're done buying bonds and I'm ready to move rates up, which both of those individually move up rates. I'll explain that in a second. He does give another quote here. He says, but I don't see that happening in 2021. Okay, whew, easy money for at least the next 11 and a half months. Nobody sees it happening in 2021. But even this guy who's like super bullish, like, yeah, let's get ready to potentially raise rates. Even he doesn't see it happening in 2021, which is good, but you want to be prepared for these things because the market, remember, the stock market likes to try to price out into the future, assuming, what's going to change. So in other words, towards the middle of this year, we could start seeing 2022 expectations get priced into the market. Anyway, he goes on to say, a whole lot would have to happen to get us there, to get us to where he starts raising rates in 2021. So he doesn't see that happening. Then he says, then we'll see into 2022, maybe the second half of 2022 or even 2023, where that might be more in play. Okay, so second half of 2022 is what Bostic's targeting. This is a big deal because again, everybody else is saying nothing's happening until like pretty much the long run, which the long run again is after 2023. There's some people on the dot plot that move up in 23, but most of them are after 23. So for somebody to go from basically 24 and on to, I think we might start in 2022, that's a big deal. And think about this. The last time the Federal Reserve did this was at the end of 2018. The Fed raised rates prematurely, causing the great, quote, taper tantrum. There was a taper tantrum in 2013 as well, but the 2018 one is much more memorable because it's recent. See, the taper tantrum led the real estate market to plunge about 12% that summer, and it led the S&P to sell off towards the end of the year 16% in a matter of just 60 days. Also, keep this in mind, it's not just a matter of rates going up, which is what happened with the taper tantrum. Taper tantrum was rates going up. Mortgage rates skyrocketed like 1 to 1.5% instantly. Prices plummeted. It's pretty painful. But guess what also happens when the Fed stops buying bonds? So remember this. If you're selling strawberries and all of a sudden nobody's buying your strawberries anymore, you get forced to drop your price. So if the Fed stops buying bonds, like your big customer, potentially your biggest customer, stops showing up to buy your darn strawberries, you got to drop the price. Well, when you drop the price on bonds, bond yields go up, aka debt becomes more attractive to buy because people spend less money to get the same coupon, the same return. Point is, when the Fed stops buying bottom line, Fed stops buying bonds, interest rates go up. Fed increases interest rates go up. Both of these things, and I'm oversimplifying a little bit here because bonds do not directly affect mortgage interest rates, but they tend to align. People look at like the 10-year treasury to predict mortgage rates. I'm oversimplifying. We don't have to worry about that. What we worry about is if the Fed is going to take the rug, start rolling up the rug earlier than we expected. It's like, hey, this party was going to keep going until 4 a.m. What are you doing rolling up the carpet at 2 a.m.? We still got another 2 hours. In reality, we still got these extra 2 years, right? It's something to pay attention to because once interest rates go up, I want to have zero margin. I want my margin paid off. I want all my taxes paid, and I'm just going to sit and go, okay, yep, I'm good. I'm good for the next decade. I will still be investing, obviously, but I'm going to be careful, and you should plan to be careful for that, too. It's not like you don't want to be in 2023 and all of a sudden hear the Fed's raising rates and then go, oh, crap, I didn't see this coming. No, you got to be prepared. Debt, very, very important regarding this. Now, now remember this too. This is the other thing to remember, and then I want to get to what the other speakers are saying. Valuations today are nuts. They're crazy stretched because 25% of the money that exists in the economy was created in 2020. Rates are super low, and we're basically expecting earnings to go gangbusters. Goldman Sachs thinks earnings are going to bump up by 30% on average in the S&P 500 in 2021, which is really, really good. 30% earnings growth is phenomenal on average in the S&P 500. But the problem is, if we raise rates, then you're almost forced to see, at the same time as you have these high valuations, you're almost forced to see asset prices come down because as rates go up, people start looking at, well, wait a minute, why am I risking my money in stocks when I can get a better rate of return now on bonds, not a great rate of return, but I could go get treasuries and actually get a rate of return instead of what it has been for the last year. Pretty miserable, but rates go up. So all of a sudden those become more attractive. People rotate out of stocks and into bonds. Oops, people talk about this great rotation about going from recovery stocks to, going from tech to recovery stocks. But a real rotation could actually be going from stocks and seeing money flee stocks, start moving into bonds again. Something to be careful of. Now, yesterday, I also shared a video response of mine to Cathie Wood projecting that the Federal Reserve might change its tune sooner than expected. I did find, like I had mentioned, I did find that Bloomberg was talking about this, I think the day before she made her video, so maybe that's where she got that from. But either way, I think she's a great mind herself. She could have entirely come up with this herself. But the point is not to try to discredit where she's getting information, because Barron's is great, whether she got her info there from not. The point is, you potentially have now many people in the industry talking about, what if the Fed does end up moving sooner than we expected? What if inflation does end up coming sooner than expected and rates do go up sooner than expected? These are potential issues. Also, if people do spend their money on stuff instead of assets, like what Cathie Wood said in her video, where she said, hey, look, as long as people are paying off debt, buying stocks, and buying real estate, velocity of money stays low, you don't see inflation. But if people spend their money on things, then we might see inflation sooner, and we'll see that tightening at the Fed sooner, which kind of aligns with what, Mr. Bostic here is saying. All things to put together and keep in mind and consider. Also, remember this, and I've mentioned this in a prior video, but keep this in mind as well. Inflation, or I should say reflation, as a search term, has jumped up quite a bit over the last, probably 2 weeks here. And so when people search for reflation, they're trying to understand what that means, inflation coming back. But then they also try to figure out what reflation trades might be. Is Bitcoin a great trade if in the event inflation comes back, right? That's the expectation here. Okay. Now, this is our market optimist, Bostic. He's our market optimist. He says, look, reduction in bond buying and rate increase possible middle of 2022, I'm game. That's what he's saying. Let's go on to the next one. The next one is Fed President Rosengren. Now, Bostic is an alternate voting member. Rosengren from Boston is not a voting member right now. So he has less power over rates relative to the last person I'm going to talk about who is a voting member. So Rosengren says he expects that purchases, that is the Federal Reserve continuing to buy bonds, buying them strawberries. This video is making me want strawberries. Anyway, he expects purchases to continue until the economy is on stronger economic footing. He thinks there is zero chance of a rate increase this year, but he's very optimistic about the economy going forward. But he is a little worried about what could happen in the second half of 2021. This was fascinating too. Here I am trying to understand what people are thinking about inflation, and I just get bombs that get thrown at me. Rosengren says he thinks that non-performing loans from residential and commercial mortgages may start appearing in the second half of 2021 as mortgage forbearance ends. Whew! Big statement. Big statement right there. Dropping them bombs. He didn't really have much else to say. But we do have Loretta Mester, and we have a transcript for her. Now, she's from the Cleveland Fed. She is the only voting member that we will be talking about in this video. And it's useful to see what she says. So I went ahead and highlighted the most salient arguments that she makes. So let's go ahead and take a look at some of the things she's saying about our economy. She's going to give us a little bit of some expectations of this is what I see happening now. And then she is going to give us some insights into her projections. Okay, here we go. And then we can blend this all together. So, by the way, did I mention yet that you should get life insurance in as little as 5 minutes via the link down below? Or 4 free stocks with Webull when you deposit $100? Or a $30 totally for free with M1 Finance when you deposit $100 with M1 Finance? All those links are down below, folks. It's free, easy money, and life insurance. Okay, a larger share of those currently unemployed are on permanent rather than temporary layoff compared to early 2020. And the unemployment rate remains very elevated at 6.9% in December, unchanged from November. This is an issue. This is a longer-term downward pressure in the economy that of the people who are unemployed, many more are permanently unemployed. There was this expectation back when the pandemic was beginning. I remember this debate so much in the YouTube comment section. there was this expectation that, sure, people are going to be unemployed because we just shut the government down, but they're all going to come back. And I multiple times said, you don't just get hired back after you get laid off or furloughed. The company ends up taking back, the 50% of people they really need, and then they trickle in, hire the rest of the people until they just decide, we just don't need everybody anymore, and we're just going to operate more leanly now. Well, that's what happened. That's good for companies and companies' earnings, but it's bad for people, and what's bad for people is bad for society because the consumer makes up 70% of the economy. Moving on. She also iterates, and this is more of a race thing here, but obviously there has been less progress for non-whites and those without a college education. Further here on the economy, she says she has seen a significant increase in people taking online training courses. Now, I don't think she's talking about like my awesome courses on building your wealth. This has to do with staffing companies, so she's talking about people trying to get a job. Although I suppose we could take the property management course, and that would set you up to be a property manager. But anyway, this suggests that people are preparing themselves to re-enter the labor force with or when their circumstances allow them to do so. So that's good. That is a positive note. Okay, then she touches on inflation a little bit in terms of what has been happening, but we know inflation has been pretty low. Instead, I want to talk about going forward. So this is her economic outlook. See? Economic outlook. What she says is, it probably goes without saying that there is a high degree of uncertainty around the outlook. Okay, well, we kind of knew that. The surge of cases obviously could have an impact on the economy, and it will take several months for the vaccine to be widely distributed. As far as the recovery, this right here, remember, she is a voting member. She's actually reiterating what Bostic said. She says, so far the recovery has generally been stronger than anticipated. This suggests we may have been underestimating the economy's resilience. Big statement here. Underlying momentum, as well as the ability of households and businesses to adapt to this unprecedented environment. That's big because remember, we go back to that dot plot here really quickly. The Federal Reserve is thinking, hey, yeah, we're not going to raise rates until 2023 or beyond 2023. This is 2023 right here, because, we think the economy needs support. But here is a voting member of the FOMC, basically somebody who has the power to vote on interest rates, saying, hey, we might have severely underestimated the strength of the economy. She says she expects the recovery to continue, but to be uneven. The post-vaccination phase of recovery is likely to continue over the next few years, with growth above trend, declines in the unemployment rate, and gradually rising inflation. Given the nature and severity of the pandemic shock, some sectors will recover slower than others. It will take time for workers who have lost their jobs to find a new one, either at another firm in the current industry or in a new industry after they retrain. That is a slowing force when people have to retrain. There may well be persistent changes in consumer preferences, buying online, right, instead of buying, going to malls and stuff, and demand for office space or even housing changes, going to those suburbs. Those changes, as well as the need to reestablish a more robust supply chain, could necessitate structural changes to the economy that will take time to unfold. Okay, now, regarding policy, my model outlook, which I've just described, depends on appropriate policy. Both monetary and fiscal policy have supported the recovery in the U.S. thus far, and in my view, both will continue to be needed to limit lasting damage of the economy from the pandemic and support the achievement of broad-based sustainable recovery. This is a very Jerome Powell line here. This is like, hey, we can't roll up the rug yet. The people still need us. We can't go roll up the rug that quickly. We still have to be here to support the people. And then she talks a little bit about what the government has done. Here, the FOMC has been maintaining the Fed funds rate target at 0% since March. We expect it will be appropriate to maintain the range until labor market conditions have reached levels consistent with our assessment of maximum unemployment or maximum employment. Okay, well, that is subjective, right? And inflation has risen to 2%. This is always very key when they speak like this because they're saying we want max unemployment and inflation at 2%. But go back to Cathie Wood's suspicion. If we see inflation jump up pretty quickly and we see the labor market, which she didn't talk about the labor market, but I'm putting the dots here together. If we see the inflation Cathie Wood thinks is going to happen and we see the labor market improve, excuse me, then it's entirely possible that, as she says here, the Fed funds rate may not be maintained at that 0 to 0.25% rate, which we've had since March. Now, interestingly, as if she wasn't done yet, and we're going to have to tie this all together here, she goes on to say one change that occurred in the US and other advanced economies is the general decline, or the decline in general level of interest rates consistent with sustainable growth and price stability. This decline reflects several factors, including an aging population, changes in risk preferences, and slower productivity growth. In other words, rates are trending down. Like inflation is becoming less and less of an issue because we do have an aging population, which maybe produces less spending and less velocity of money. They save more. Maybe there is slower productivity because, hey, we had this big productivity boom with all this technology, but now as we advance technology, we're becoming incrementally more productive, but we're not becoming so much more productive that all of a sudden we're going to have all this crazy inflation because everybody's able to make, 20 times the iPhones they were able to make last time. So, okay, this is a little bit of a counter argument here. So earlier she's like, hey, look, we might have to raise rates sooner if the economy does really well and hits our targets. Like, she's ready to do that. Now she's kind of saying, but keep in mind, we might not see inflation or the need to raise rates because of the changes that are actually happening in our economy and our society. And these are, by the way, considered structural changes. When you hear things like this, the aging of a population, the changes in risk preferences, and the slowing of productivity growth, those are structural changes. And economies that go through this kind of structural change generally experience lower inflation. So you've got really this is like a tug of war, and I feel like the video feels like a tug of war because, well, it is. It is a tug of war. Then she says, because they're basically at zero now with interest rates, households, businesses, and financial markets understand the Fed is at zero and that they can't go lower than that. So because of that, households, businesses, and financial markets think that inflation will remain low. So that imparts a downward bias to inflation expectations and so increases the downside risks to achieving our policy goal. Okay, so this is a little tricky. She's basically saying, because we've sat at zero for so long, people think we're going to stay at zero forever and we're not going to see any inflation. And because of this, that basically there will be no inflation because people will not rush to go out and buy something. If we think something is going to be more expensive next year than it is now, we'll go buy it today. If we think it's going to be the same or cheaper, then we have no rush to buy, so inflation actually stays low. Really kind of weird. I mean, this gets into behavioral economics, and it's really fascinating. I love it. Then she says, the goal is to have inflation run moderately above 2%. And she says, and clarifies this, in other words, not only will we be comfortable with serendipitous shocks that move inflation above 2%, aka occasional shocks that move inflation above 2%, but we will set policy to intentionally move inflation above 2%. So we do expect inflation to go above 2% from time to time. They are doing some prepping here because we will be seeing inflation probably hit 3% soon. And I've brought this up for course members many times. I've explained this, but I'm going to bring it up here again. These are the inflation levels that we had last April and May. When we get the April and May data in May and June of this year, we are going to, compared to that period of time, probably see somewhere around 3 to 3.5% inflation. And that's just a year-over-year snapshot. It doesn't mean that all of a sudden, oh my gosh, inflation is crazy. It's because we almost had deflation over here at the bottom of the V-shaped recovery. So of this, what looks like a V-shape, right? But anyway, let's move on here to the rest of what she says here. So do expect that inflation will come. We will see that 3% for year-over-year for a couple months in the next few months. I personally think that's going to send Bitcoin to the moon because people are going to lose it. And they're going to go, oh my God, inflation is here to stay. And Bitcoin's just going to skyrocket. It's going to be nuts. But anyway, then she also goes on to say, a slowdown in the economy in the first part of the year along the lines I am expecting would not require a change in monetary policy. So in other words, if the economy slows down like we think it will in Q1 2021 just because of COVID cases, no worries, we're just going to stay the course. Nor would strengthening, and this is actually finally a little bit of a conclusion, nor would the strengthening in growth I expect to see later this year necessitate a change in our policy stance because I expect the economy will still be far from our employment and inflation goals. But because I'm telling you, this tug of war doesn't end. On the other hand, the resiliency shown by the economy so far suggests there is a possibility that the post-vaccination recovery could be stronger than expected. Okay, this is a whole lot of stuff that I went through here, but it educates you on all the crap that's going on. Here's the Kevin conclusion. The Kevin conclusion is very clear. If the Federal Reserve is like, hot damn, we got a hot market again, they are going to change their tune really fast, like Cathie Wood says. I totally agree with that. I do think that there are structural changes in our economy that say we should be heading towards lower inflation. We should be. But we can't deny all of the insane money printing that has been happening and been going on. As a result, we have to be careful with our investments. I highly encourage, if you're getting into real estate, lock in 30-year fixed rate loans. If rates go down, you'll refinance in the future. If rates go up, you're fixed. You're locked, you're golden. It's good news. If rates or inflation shows itself sooner, you're also going to want to be careful with your margin debt, because margin debt is usually variable interest rate. So be careful when it comes to the stonks. If rates go up, we'll probably see stocks get punished a little bit in the short term. I think those could end up being buying opportunities. That's really going to be a discussion for the future as the market kind of adjusts to higher rates. I do not think that we'll ever see very high rates again. Like, I think we'll go back to that 2 to 3% Fed Reserve rate, where we get the high yield savings accounts around 2%, 3%, maybe on those specials. I do not know that we'll ever go back to what we saw, back in the 70s, where we had 10, 15% inflation, but you never know. So you got to be prepared for everything. Hey, if you found this helpful on the Fed, breaking down all this research for you in hopefully a simple to understand way, consider subscribing to the channel. This is the stuff that I like doing. I get enjoyment out of this. Hopefully you do too. I know it's a little more nitty gritty, but all this is designed to help you build your wealth. That's what I want for you, because I know that the more you build your wealth, the more success you can achieve. Thank you so much for watching. Appreciate it. And folks, we'll see you in the next one.